Stock Market Basics. What every beginner should know. Hey everyone, and welcome back to X100%. I'm your host, Eddie, and I'm absolutely buzzing about today's topic. We're diving deep into something that can feel super intimidating, but it doesn't have to be. If you've ever looked at the stock market and thought, that's not for me, or I'll never understand that, then buckle up, because we're about to change your mind. Today, we're tackling stock market basics. What every beginner should know. And trust me, by the end of this episode, you'll feel a whole lot more confident. I remember when I first started thinking about investing. It was after college, and I had finally landed a real job. I was saving a little bit of money, but it was just sitting in a savings account, earning next to nothing. I knew I needed to do something more with it, but the stock market seemed like this mysterious, complicated beast. I was afraid of losing everything. I spent weeks reading articles, watching videos, and still felt completely lost. That's why I'm so passionate about breaking down these topics in a way that's easy to understand. So, let's start with the fundamental question. What exactly is the stock market? We touched on it briefly before, but let's really unpack this. Imagine not just a marketplace, but a global network of marketplaces, all connected electronically. Instead of physical goods, people are buying and selling ownership in companies. These are the stocks or shares. Think about some of the brands you use every day. Apple, Google, Alphabet, Amazon, Coca-Cola. These are all publicly traded companies. That means anyone can buy a piece of them through the stock market. Let's go back to the daily grind coffee shop example. Imagine they're doing really well, and they want to open not just one, but 5 new locations. They need a significant amount of capital to do that. They could take out a loan, but that comes with interest payments. Or they could sell shares of their company to the public. When you buy a share of the daily grind, you're not just buying a piece of paper. You're buying a piece of their future success. You become a shareholder, and you're entitled to a portion of their profits, if they choose to distribute them as dividends. You also have a say in how the company is run, although your influence depends on how many shares you own. The stock market facilitates all of this buying and selling. It provides a platform for companies to raise capital and for investors to participate in the growth of those companies. The New York Stock Exchange, NYSE, and the NASDAQ are the 2 biggest players in the US, but there are stock exchanges all over the world. They use sophisticated computer systems to match buyers and sellers in real time. Okay, so we know what the stock market is, but let's dig deeper into why you should consider investing in it. We mentioned growing your money, but let's talk about the power of compounding. Compounding is like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more and more snow, growing exponentially. In the stock market, compounding means that your earnings generate more earnings, which in turn generate even more earnings. It's a powerful force that can significantly accelerate your wealth accumulation over time. Let's say you invest $1,000 in a stock that grows by 10% per year. After 1 year, you'll have $1,100. 1,000 times 0.1 is equal to 100, 1,000 plus 100 is equal to 1,100 after 2 years. If it grows by another 10%, you'll have $1,210. 1,100 times 0.1 is equal to 110, 1,100 plus 110 is equal to 1,210. That extra $10 is the magic of compounding. Over time, that effect becomes much more pronounced. But it's not just about growing your money. Investing in the stock market can also provide a hedge against inflation. Inflation is the rate at which the prices of goods and services increase over time. If your money is just sitting in a savings account, its purchasing power erodes over time due to inflation. The stock market historically has outpaced inflation, allowing you to maintain and even increase your purchasing power. And let's not forget about those financial goals. Want to buy a house? Retire early? Send your kids to college? The stock market can be a crucial tool in achieving those goals. It's not a guaranteed path to riches, but it offers the potential for significant returns that can help you reach your dreams. Alright, time to demystify some more jargon. Let's go beyond the definitions and really understand these key terms. 1. Stock/shares. We know they're pieces of ownership, but there are different types of stocks. Common stock gives you voting rights in the company. Preferred stock usually doesn't have voting rights, but it pays a fixed dividend. 2. Dividends. Think of dividends as a thank you from the company for being a shareholder. Companies that are profitable and have excess cash may choose to distribute a portion of those profits to their shareholders as dividends. It's like getting a regular paycheck just for owning the stock. 3. Bonds. When you buy a bond, you're essentially lending money to a company or the government. They promise to pay you back with interest over a set period of time. Bonds are generally considered less risky than stocks because the interest payments are usually fixed. However, they also offer lower potential returns. 4. Mutual funds. Imagine you want to invest in a variety of different stocks, but you don't have the time or expertise to pick them yourself. That's where mutual funds come in. A mutual fund is a collection of stocks, bonds, or other assets managed by a professional fund manager. They pool money from many investors and invest it according to a specific strategy. 5. ETFs, exchange-traded funds. ETFs are similar to mutual funds, but they trade on the stock exchange like individual stocks. This means you can buy and sell them throughout the day, just like you would with a regular stock. ETFs often have lower fees than mutual funds, making them a popular choice for beginners. 6. Diversification. This is your safety net. Don't put all your money into one stock. Spread your investments across different companies, industries, and even asset classes, like stocks and bonds. This reduces your risk because if one investment performs poorly, the others can help offset the losses. 7. Risk tolerance. This is a personal thing. How comfortable are you with the possibility of losing money? If you're risk-averse, you might prefer to invest in bonds or low-volatility stocks. If you're more risk-tolerant, you might be willing to invest in higher growth stocks that have the potential for greater returns, but also greater losses. 8. Volatility. This is the ups and downs of the market. Stocks are generally more volatile than bonds, meaning their prices fluctuate more. Don't let short-term volatility scare you. Remember that investing is a long-term game. I know that's a lot to take in, but don't worry, we'll keep revisiting these concepts in future episodes. The goal is to build your understanding gradually. Okay, you're feeling informed, maybe even a little excited. Let's get practical. How do you actually start investing in the stock market? Let's break it down step by step. 1. Open a brokerage account. This is your gateway to the stock market. Research different online brokers like Fidelity, Charles Schwab, Robinhood, Vanguard, and Interactive Brokers. Compare their fees, investment options, and user-friendliness. Some offer commission-free trading, which can save you money, especially when you're starting out. 2. Determine your investment goals. What are you saving for? Retirement? A down payment on a house? Knowing your goals will help you determine your investment timeline and risk tolerance. 3. Assess your risk tolerance. How comfortable are you with the possibility of losing money? This will help you choose the right investments for your portfolio. 4. Decide how much to invest. You don't need a huge sum of money to get started. Many brokers allow you to invest with as little as $5 or $10. The key is to start small and gradually increase your investments over time. 5. Choose your investments. As a beginner, I highly recommend starting with mutual funds or ETFs. They offer instant diversification and are managed by professionals. Consider investing in a low-cost index fund that tracks the S&P 500. S&P 500. This gives you exposure to the 500 largest publicly traded companies in the United States. 6. Reinvest dividends. If your investments pay dividends, consider reinvesting them back into the market. This will help you take advantage of the power of compounding. 7. Stay consistent. The key to successful investing is consistency. Set up a regular investment schedule and stick to it, even when the market is volatile. 8. Rebalance your portfolio. Over time, your portfolio may become unbalanced. This means that some investments may make up a larger percentage of your portfolio than you intended. Rebalancing involves selling some of your winning investments and buying more of your losing investments to bring your portfolio back into alignment with your original asset allocation. Let's learn from the mistakes of others. Here are some common pitfalls that beginners often fall into. 1. Investing without doing your research. Don't just blindly follow the hype. Understand what you're investing in. Read the company's financial statements, understand their business model, and assess their competitive landscape. Example. Remember that time everyone was talking about that one meme stock? People jumped in without knowing anything about the company, and many lost a lot of money when the bubble burst. 2. Trying to get rich quick. The stock market is not a casino. It's a long-term investment strategy. Don't try to time the market or chase hot stocks. Example. I once knew someone who tried to day trade, thinking they could make a quick buck. They ended up spending hours glued to their computer screen, stressed out, and ultimately lost money. 3. Letting emotions guide your decisions. Fear and greed can be your worst enemies in the stock market. Don't panic sell when the market goes down, and don't get greedy when the market is going up. Example. During the 2008 financial crisis, many people panicked and sold their stocks at the bottom of the market. They missed out on the subsequent recovery. 4. Not diversifying. Putting all your eggs in one basket is a recipe for disaster. Spread your investments across different companies, industries, and asset classes. Example. Imagine investing all your money in a single company, and that company goes bankrupt. You'd lose everything. 5. Ignoring fees. Fees can eat into your returns over time. Pay attention to the fees charged by your broker and the funds you invest in. Choose low-cost options whenever possible. Example. Even a seemingly small fee of 1% can significantly reduce your returns over the long term. Alright, let's bring it all together. Today, we've covered a lot of ground. You now have a much deeper understanding of the stock market, why it's important, and how to get started. We've explored the concept of the stock market as a global network for buying and selling ownership in companies. We've discussed the power of compounding and how it can help you grow your wealth over time. We've demystified key terms like stocks, bonds, mutual funds, ETFs, diversification, risk tolerance, and volatility. We've provided a step-by-step guide to getting started, from opening a brokerage account to choosing your investments. And we've highlighted common mistakes to avoid, along with real-life examples to illustrate those pitfalls. Ultimately, you've learned that the stock market isn't some scary, inaccessible place. It's a tool that, when used wisely, can help you achieve your financial goals and build a more secure future. That's all the time we have for today's extended episode of X100%. I truly hope this deep dive into stock market basics has been helpful and empowering. Remember, investing is a journey, not a destination. It's about learning, growing, and adapting along the way. Don't forget to subscribe to the X100% podcast so you don't miss out on future episodes packed with actionable tips and insights on personal finance and investing. And if you have any questions, suggestions, or topics you'd like me to cover, please leave a comment below or reach out to me on social media. I love hearing from you. Thanks for tuning in, and I'll catch you in the next episode. Keep learning, keep growing, and keep investing in yourself.